Hello and welcome to today's video. Today's topic will be a review of the last earnings and earnings call from Lululemon. For you that follow me longer, probably you have an idea that this is one of my core positions currently. Market definitely wasn't merciful to Lululemon, especially last couple of months, and the question now is if there is a turnaround on the horizon, and this is what I will try to decipher in today's video. Without further ado, let's start. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. First, on to some positives from their earnings. So international momentum remains very strong. Revenue in international markets grew 22% and comparable sales grew 15%, giving signals of healthy demand and market expansion outside of the US. Then overall revenue growth continues. Total net revenue increased 7% to $2.5 billion. Gross profit still growing. So gross profit increased 5% to $1.5 billion, and they exceeded expectation on earnings per share during this quarter. Store expansion continues. The company added 40 new stores and now operates 784 locations, and they ended the quarter with $1.2 billion in cash and cash equivalents plus $393 million available on the credit facility. And regarding share repurchases, they repurchased 1.1 million shares for $278.5 million, an average price of roughly $247 per share. So now on to some bad highlights. So US performance is weak. America's revenue increased only 1% and comparable sales fell 4%. Management explicitly expressed disappointment with US product execution and business results. Overall, comparable growth barely positive, so comparable sales increased only 1%, driven entirely by international markets, and gross margin contracted, so gross margin decreased by 110 basis points to 58.5%, reflecting higher inventories and cost pressures. Income from operations fell 3% and operating margin declined by 210 basis points to 20.7%. Diluted earnings per share were $3.10 compared to $3.15 last year, and although EPS exceeded expectations, revenue came in below their own forecast, primarily because of the US underperformance. So, some closing thoughts for the earnings part. The core issue remains the ongoing weakness in the US market. This is where most of the pressure on revenue and comparable sales originates. Rate cuts could provide some relief over the time as consumer sentiment improves, which may help stabilize demand, but for now the US segment is the primary drag on the performance. Margins took a hit this quarter, yet they still operate at levels most retailers would consider elite. That tells us that the long-term profitability engine is intact, even if execution challenges are visible. The positive side of the story lies in the international segment. These markets continue to grow rapidly and are becoming an increasingly meaningful share of a total revenue. As this mix shift continues and US sales eventually stabilize, the current headwinds should gradually become a smaller structural issue. Now switching on to earnings call. So first the good stuff. Management emphasized that several brand building initiatives are working and new product innovations are resonating well with customers. The program for membership now includes approximately 30 million members, strengthening long-term customer loyalty. The company plans to increase new styles from 23% of the assortment to around 35% next spring, a strategic shift aimed at fixing product fatigue in core categories. China revenue grew 25% with additional store openings and strong activation events like the annual Summer Sweat Games. The rest of the world segment grew 19% with new markets opening in Italy, Turkey and Belgium, and India scheduled for 2026. For the CapEx, so full year capital expenditures is now projected to range around 700 to 720 million, providing more flexibility for cash flow and investment pacing. And management noted that no single competitor is meaningfully impacting results, suggesting the brand equity remains strong even in a more crowded market. Now on to some bad stuff. So full year guidance was lowered, primarily because of the weakness in the US market, where revenue is now expected to decline 1 to 2%. Higher rates and changes to the de minimis provision are materially impacting costs and played a major role in cutting annual guidance. Product cycles are becoming too long. Management admitted that several categories, especially lounge and social, became too predictable. This slowed trend creation and demand. Gross margin is expected to decline approximately 300 basis points for the year. Q3 is expected to see an even larger decline of about 410 basis points. EPS is moving lower, so full year EPS was reduced and Q3 earnings per share are now expected to come below last year. China is showing early signs of slowing, so Q2 revenue landed at the low end of the expectations as macro headwinds begin to show in Tier 1 cities. Inventory levels are rising, so units are expected to increase in the low double digits, while dollar inventories rise in the low 20s because of the tariffs and foreign exchange. And lower sales, FX pressure, and ongoing investments into the Power of 3 x 2 roadmap are waiting on operating leverage. Now on to some price action. So from a technical perspective, the price has been trading in a tight range for the past 11 weeks, holding between the low 160s to the low 180s. And this zone looks like a potential accumulation area, and that view gains additional credibility with the recent increase in the Lulu positions by the super investor Michael Burry. Some final thoughts from my side. I think management effectively reset all expectations, which means the market could react positively if the earnings turn out to be less bad than feared. Then again, I thought the same for the previous report and was proven wrong. As they say, prepare for the worst and hope for the best, especially now when the broader market is showing signs of weakness. This is it for today's video. If you want a written article on this topic, check my Substack. Also, if you want more daily insights and market updates, subscribe to my X account, and for more educational content, check my website. Links for everything will be in the description of this video. Like and subscribe for the support, and see you in the next video. Bye.